Welcome back to episode number 3 of Find My Way Home Live. We have a couple of special guests here, an extra special guest. They're both named Scott, so hopefully that doesn't confuse us all tremendously tonight. But we've got Scott Beatty, one of our Find My Way Home experts out of the state of Colorado, and we have my business partner both in Bywise Mortgage and the founder of Find My Way Home, Scott Shang, joining us tonight. So thanks for joining us, gentlemen. We have a topic that over the last 5, 6, 7 years has been one of the biggest sources of consternation for home buyers and confusion for loan officers and lenders, and for various reasons. Sometimes ignorance, sometimes changes on the parts of lenders, but it is a big issue. Currently, 46 million Americans have student loan debt, and for a total of $1.75 trillion. You'd have to be living under a rock to not see the headlines of Biden's going to, let cancel certain amounts of student loan debt for certain home buyers or certain borrowers, student loan borrowers, and there's pushback. The left thinks it should all be canceled. The right thinks none of it should be canceled. The answer may be somewhere in the middle, but tonight we're not going to discuss that at all. We are only going to go through those of you who are in the market looking to buy a home and you have questions regarding your student loans. We're going to kind of go through the history of the guidelines and why this really is an issue. And one of the things we want to talk about is the prime home buying age is early 30s for your first time home. Millennials are entering that prime home buying age, and they hold the vast majority of this student loan debt. The government, about what was it, Scott, 2008, 2009, 2010 maybe, under the Obama administration, rather than say, hey, let's figure out how to not get kids burdened with so much student loan debt, they came out with a way that they didn't have to pay as much on the student loan debt. And that is the income-based repayment, income-driven repayment, pay, repay. There's a plenty of different names that it goes under. But essentially what it means is you're not paying enough on your loan to pay it off. And at some point there will be forgiveness. So why don't we talk a little bit, Scott Shang, you want to give us a little bit of an introduction of why that's problematic for a lender, for you to have a loan with a debt that has a payment that won't be paying it off?
Yeah, well, I mean, you kind of mentioned that we weren't going to talk about forgiveness, but we kind of have to talk about forgiveness a little bit, because the primary reason somebody would take an income-based payment, or initially the reason people would, was because of what's called the PSLF program, which is the Public Service Loan Forgiveness Program. And it said, as long as you made on-time payments for 10 years and you worked in some capacity as a public servant, then you could have your loan forgiven after 10 years. Well, what most people don't know is all student loans can be forgiven if you are making a payment on time for 20 years. And actually, just a few weeks ago, they updated those guidelines, and they've actually shortened that time period for even more student loan holders that can have that debt forgiven earlier. And this isn't loan forgiveness. This is just clarifying and expanding the loan forgiveness part. So if you have $300,000 worth of student loan debt, which sounds crazy, but it really isn't with what we see on a pretty regular basis, at least six figures, you may not want to, especially just coming out of school, making those payments. So you're right, Josh, they introduced this payment that was not enough to pay off the loan in full. So in 2015, kind of with the reverberation of the reverberation of the crash, when we had all of these loan programs that the payment wouldn't pay off the loan, and so many people lost their homes because of that. They called them toxic loans at that time. Well, around 2015, after the market kind of got on its feet again after 2008, 2009, all of the loan programs, and we're primarily talking about Fannie Mae and Freddie Mac, which are both conventional loan guidelines, and then you have FHA, VA, and USDA. And so that's important when we're having this conversation. So they all kind of looked at this and they said, man, there's all of this outstanding student loan debt and they're not making payments to pay it off. So how do we calculate in the qualifying ratio of how much you can, how much debt you have to count when you're calculating how much mortgage payment you can qualify for? How do we deal with that?
And Scott, the funny part, or a funny part about that, is these guidelines, the income-based repayment programs kicked off around 2010. Lenders had no idea. I know their heads were just under a rock until like 2015. So we're going to talk about how the guidelines changed a lot from 15, 16, 17, even into 2020 and 2021. We've seen fairly big changes because there's not really a right answer to how to handle this. And part of the reason why, if we had a purely privatized lending system, most mortgage lenders would look at this and say, no way, I don't want any part of that. Way too much uncertainty. Any number of things can happen. But since the student loans are a government loan program, government insured loan program, and FHA, VA, Fannie Mae, Freddie Mac, also government insured programs, the government is saying, we better figure out a way to make this work. We've created a terrible system with lots of uncertainty and confusion, but let's make some rules. And that's really where we're going to go tonight, is to talk through all of those rules, and depending on which type of loan you want to get, what's going to apply to you currently.
And this is sort of the crux of the problem, because all 5 of those lending guidelines all decided to have different rules. And like you said, in 2016, 2017, 2018, they all decided to change those rules. So until just recently, depending on whether you're using a Fannie Mae or Freddie Mac conventional, or FHA or VA or USDA, they were completely different guidelines for how you treated your student loan payments. And that's what caused the confusion, both for consumers and especially for loan officers that weren't paying attention to this the way that we were. And, they didn't have a lot of experience. So they looked up one guideline and said, here's your answer.
Why don't we jump in and start looking at these in order?
Okay.
Scott Shang doesn't actively originate, so he doesn't have as many real world examples, but Scott Beatty and I both are dealing with borrowers all day, every day. So when we have them, we're going to throw in some examples here of how it works and how it impacts borrowers and the dead ends they're hitting and when that's right and when that's wrong. But I always like to start the discussion with FHA. Couple reasons. FHA was historically the most difficult. They actually had an unofficial guideline prior to 2016 that was posted in an FAQ that said, hey, you could use whatever's on the credit report. And then one day they woke up and they go, that's terrible. We're going to make you use 1% of the student loan balance. So if you have $10,000 or $12,000 of student loans, not a big deal. It's $100, $120. We see clients all the time, doctors, lawyers, with $200,000 and $300,000 of student loans. So that doesn't work so well. Scott Beatty, you want to kind of walk us through where FHA is now? In the past, it was that 1%. 1% made it really difficult for a lot of the first-time buyers who wanted to take advantage of the flexibilities of the FHA 3.5% down, flexible credit guidelines, and they weren't able to until some of the recent changes.
And the strictness of the FHA plan, that was even worse than the 1%, is if they had a lower payment, they still had to use the higher of the two. So it was even more restrictive than what we have today. For FHA, in June of 2021, they updated the guidelines that aligned with one that we're going to talk about later, which is Freddie Mac. They will let you use an income-based repayment plan unless that payment is zero. And that's where it can get tricky. Someone knows that they're in an income-based payment plan. They'll tell you that they're in one. But if the number is zero, FHA doesn't like that number. You're actually better off with a $1 payment than you are with a zero payment. And the reason for that is that if it's zero, they don't feel that that's adequate, and they're going to make us count 0.5% of the balance as the monthly payment for that particular payback.
So from
Absolutely.
1% to 0.5%.
from
Yeah.
1% to a half, and sort of the elephant in the room that we didn't talk about on the way in, because we're thinking bigger picture of the guidelines. We didn't really get into the CARES Act and the reason why the CARES Act put this issue on steroids. So CARES Act forbearance during COVID, very quickly the government came out and said, we're putting a pause and putting all federally backed student loans into forbearance, which meant that everyone, let's say you owed $100,000, you're on an income-based repayment and it was $100. You're going to see many of these guidelines would allow us to use that $100 off of the credit report. But that went to zero. And as you just saw with FHA, zero is not acceptable. So a lot of the issues that borrowers are having right now are due to the fact that all loans are in forbearance, all federally backed student loans are in forbearance, and they all are reflecting a zero payment. So in that instance that you just mentioned, Scott, if someone actually has an IBR payment, but their credit report shows zero, what are their options? Do they have to go to the 0.5% with the FHA, or do they have another route to work around?
They need to reach out to their student loan company and get what the payment is. They can actually have that payment adjusted to what it was. We're seeing like right now, a lot of people just aren't paying even though they are in forbearance. A lot of times they don't even know what they should or shouldn't be doing. But so long as we have documentation that shows what the income-based repayment would be, if it wasn't registering as zero, then we can use that number.
And I don't know what you guys are seeing or what you, Scott Beatty, are seeing. A lot of the servicers, normally every 12 months, if you're in an income-based repayment plan, you have to go back and recertify and show them what your current income is. If your income's gone up, they want you to pay more. Well, they just stopped because they're like, why are we going to do this? No one's required to make any payment. We're going to leave that at that level. So it's been somewhat of an issue. I've had a couple of clients that they were passed, so they had the documentation. They go, hey, I got a $225 a month IBR payment. And it says, yeah, but it renews in January of 2022, and we're in February of 2022. Right. I don't know what you're seeing. For the most part, servicers on our end, they're like, no problem. We'll push it out 12 months. Here's a new letter. They're not actually having them recertify. Once CARES Act goes away, if our president ever allows CARES Act forbearance for student loans to go away and makes payments come back, that will be less of an issue. You want to transition then there from FHA, Scott?
Well,
FHA
what I also wanted to kind of add in there is the reason why the administrative forbearance forced by the government was such a problem is because all 5 of the underwriting guidelines made you use a calculation if the loan was in deferred or in forbearance. So administrative forbearance wasn't really forbearance because they were in a payment plan. The government just refused to allow you to make payments unless you contacted.
They didn't give you a choice. You couldn't not be in forbearance.
Right. So if you were in a repayment plan prior to that, you're saying most servicers or most lenders and underwriters are saying, okay, just show us what the payment was prior to the government turning it to zero.
So we started with FHA because it's used extensively by first-time buyers because of its flexibilities and low down. The next 2 options we're going to talk about are Fannie Mae and Freddie Mac. When you talk to a lender, they're probably not going to talk to you about Fannie Mae or Freddie Mac. They're going to just tell you it's a conventional loan. For the most part, the guidelines and the rates for those 2 loans are 99% the same. Income-based repayment student loans is one of those 1% things where they're different. So Scott Beatty, you want to jump through Fannie Mae and tell us how they're currently looking at income-based repayment student loans?
Yep, and this one caught me a little short right when these changes made, because like you said, conventional is used interchangeably. So typically we almost always go the Fannie Mae route. That's one that is just the more common route that we go. But the downside to the Fannie Mae program is if you have a $0 income-based repayment plan, they don't like that either. They're even stricter than FHA, and they actually revert back to the 1% plan. So if the payment is showing as zero, again, $1 is better than zero. So go back to the student loan servicer and get that payment figured out so that we can count that for you versus having to use the full 1%. Because one thing I don't know that we really mentioned is the average student loan payment is far below 1% or even below 0.5%. So we really want to be using the true student loan payment if possible, or the income-based payment plan versus the higher 1%, which Fannie makes us use.
Absolutely. And again, all of these are going to come back to, if you're in the market to get a student loan, get ahead of this, or get a mortgage and you have income-based repayment student loans, get ahead of it, reach out to your servicer and get the documentation of what your income-based repayment plan is there. So one of the interesting things is Freddie Mac, basically, we talked earlier that FHA mirrored Freddie's guidelines. So with that, it's 0.5% that they'll use. And one of the flexibilities there, Scott, much like you, we do probably 85% of our loans are going to go through Fannie Mae. It's a simpler automated underwriting system to use. Really, when we go to Freddie Mac, it's just to see if their automated underwriting system will give us an appraisal waiver when maybe sometimes Fannie Mae won't. But one of the interesting quirks is they use a 0.5% calculation. And you may say, I've got an income-based repayment. I don't care what calculation they use. But for a lot of our borrowers, if they've got $30,000 or $40,000 or $50,000 of student loans, that 0.5% calculation may not kill them. So what might kill them is the 10, 20, 30 minutes, 4 hours, 6 hours, 2 weeks following up with their student loan servicer and trying to find out how to get that paperwork. So we've had a handful of clients where we just switched the file over, went Freddie Mac, and the 0.5% enabled them to qualify without providing us any documentation. And again, some of those clients that have very small student loans where they're a $10,000 student loan, they can probably go Fannie Mae regardless. It's a $100 payment. A lot of times their debt to income will allow them to absorb that.
Yeah, so Josh, it looks like we have a question here from a viewer on YouTube, and this is really common. If the payment is not shown on the credit report, but she does have a monthly payment, is that acceptable? And how does she show proof?
So it is acceptable, but it's a specific letter. Like a lot of our clients have their servicing through FedLoan. If you just go to FedLoan and say, I need a letter, they might give you a history of showing, hey, I've been making these payments. It's not about whether you were making the payments or not. It's about showing what the required IBR payment would be if you weren't currently in administrative forbearance. So all of the servicers have been cooperative. I have yet to run into one that couldn't provide the required documentation. But what you want to show is these student loan account numbers, because most of our student loan borrowers have more than one. Some of them have consolidated down to one, but often there's 6, 7, 10 loans there. You want all of the loans listed. You want to say what the total balances are, what the minimum payment is in the income-based repayment, and you want that date of when it is good through. So it has to be effective at least through closing. So if you close on May 31st, it needs to be good through at least June 1st. And we've had them that tight. And we have one little quirk with that with VA that we'll get to in a minute. But Mary, to answer your question is, yes, you can get the documentation from your servicer regardless of what your credit report says, and then revert to the guidelines for each one of these programs of how they handle income-based repayment student loans.
Yeah, good question. It's a common question.
So the fun one here is VA. They kind of went a little rogue with theirs. The VA,
they like math.
They like math, and they also, the VA guidelines are really, really vague on whether they will accept an income-based repayment. So we reached out recently. We had a client and went and said, we're not seeing the answer here. So we called the Regional Home Loan Center in Phoenix, where they will answer these questions for us. And we said, hey, we have a client with income-based repayment. We have the documentation. It shows it's $178 a month. Can we use that? They said, no problem. It just has to be good for at least 12 months. I said, well, you realize they actually go back every 12 months and have to recertify. So it will never be good for more than 12 months. And I shouldn't say never, because during the administrative forbearance, I had one get pushed off a year from before it was. So that wasn't a VA borrower, but it would have been the only one I've ever seen that was further than 12 months out.
Isn't it 12 months from the first mortgage payment, though, not from the application? So it's really
Yeah.
13 months.
Yeah. So
And
anyway
that
you
makes
cut it, it's like they're saying, yeah, we're cool with it. Just get us this thing, this purple unicorn. So if you can
it
bring us a
doesn't
purple
exist.
unicorn with your loan application, yes, you can
So
use that.
instead, do some math.
So instead, we're going to get super creative. So instead of a 0.5% of your balance a month, 1% of your balance a month, we're going to go 5% annually and then divide that by 12 to get back to the monthly. The good news is that gives you 0.4166%, which is the lowest of all of the calculations. Still, for veterans who have a lot of student loan debt, it can be problematic. The good news is because of the GI Bill, we don't see a lot of veterans with the big student loan debt like we do others. Some of them come through, but they don't tend to have quite as much. Now, Scott Beatty, for us here in Southern California in general, we don't do a lot of USDA. Out in Colorado, do you guys have much experience with USDA?
There's pockets that do it. That's typically not in our market. We have recently had one though that had student loans, and uh, the 0.5% that USDA allows didn't get us to where we needed to be. They just didn't qualify.
Okay, so with that, the important part to know is USDA is just a hard no. They're not going to take an IVR payment. You can document it 6 ways to Sunday. They say, cool, don't care. We want we want to see a 0.5% of the student loan balance. Do you know, Scott? And again, doing the research that Scott and I have done over the years of looking at this, I've never seen almost all of these programs. If you can show a fully amortizing payment being less than 0.5%, they'll generally take that. But 0.5% is usually a pretty good approximation. It might be a little higher, a little bit lower, but it usually comes in pretty close, depending. Those of you with student loans who might be watching this know you can pick a repayment term. You can stretch it out as far as possible. You can shorten it up if you want to get it paid off. So it all depends. But for the most part, if you can document that you have a fully amortizing payment like any other closed-end installment debt, you should be able to use that monthly payment. Now,
Josh, let me stop. I'm glad you said that because that was kind of my trick to get around all these calculations before the rules changed. And you can call your servicer and say, I need you to give me the lowest payment you can possibly give me. It needs to show that it pays off at some point, and it could be a 30. I think I've seen 30-year notes on student loans just to get that payment down low enough to where they could qualify. That is still an option even with the income-based repayment plans. So don't think that you can't, that you just have to follow these guidelines. There's other ways to lower your student loan payment.
and tell me this, Scott, in your experience, how long does that process take? I mentioned that to clients and some say, I don't have time for that. We're in escrow, or we just found the perfect house. How long does it take to go through that with a servicer?
I think it depends on how motivated you are to buy a house, but typically within a few days you can have a letter faxed to you that shows you this lower payment. So motivated people have no problem getting it. It's just a matter of putting in the groundwork or the legwork to do that. One thing I would add is if you have student loans, you want to buy a house in the next 6 months or so, like Josh said, you want to get ahead of this now. If once that forbearance ends, the student loan companies are going to be slammed with people calling in trying to figure out things out. So now is the time to figure that out with your student loan company before that forbearance ends.
Absolutely. Now let's go to the free-for-all section of the show when we talk about jumbo and portfolio lenders. So jumbo lenders are loans that are larger than Fannie Mae, Freddie Mac, FHA will do. We also can throw in non-qualifying mortgage lenders that do fun, weird stuff like bank statement loans, debt service coverage ratio loans, and then also portfolio lenders. You may have a local credit union that doesn't sell their loans, they keep them. A small local bank may keep their loans. And the cool thing is they all get to make up their own rules with this. So the hard part is trying to give you an answer of exactly how they're going to look at it. So within that big stew of different types of loans that I just threw out there, Scott, what are you seeing of options for anything less than 1%?
The ones I see that and I get the most questions on in that jumbo or outside of the Fannie, Freddie, FHA, VA realm is doctor loans. Doctors obviously have a ton of student loan debt. There are certain lenders out there that will ignore the student loan payments, at least for the time being. They'll qualify them without those student loan payments, counting them at all. but that is very specific to that industry. You have to have a job that you're going to, and they're just counting on you making enough money down the road to where you'll be able to pay back those loans. But that's one of the few that I've seen that you can actually essentially ignore the student loan payment.
One of the things that we've seen post-COVID, so prior to COVID, we were getting more and more jumbo options. The market was opening up, people were doing different things. COVID shut that down. By the end of 2020, that market started to thaw, and now we do have a handful. I wouldn't say a lot, but I would actually say most wholesale lenders, most big national lenders have jumbo programs that will follow the Fannie Freddie guidelines. So the guidelines that we went through earlier, now those loans may not have the best jumbo terms, but they're more flexible because they're following Fannie Freddie guidelines. What I can say is the lenders that we have access to that have the absolute best terms on jumbo are incredibly strict on the student loans. Most of them will fall back to that 1% unless you can show a fully amortizing payment, which might take you, Scott, back to the option that you were talking about of just getting a 30-year amortizing payment
Right.
and decreasing it.
Exactly.
We had a couple of other things to consider. So in general, did either of you guys have anything to add just in terms of the 5 major loan types of how they handle student loans, or anything that you think our viewers might want to hear?
For me, the big thing is I think there's still underwriters that are learning this. Make sure that the loan officer that you use is really aware of these nuances between the programs, because it'd be very easy for an underwriter to say, hey, this is a conventional loan, it's going to be 1%, not even thinking about Freddie Mac at 0.5%. So be your own advocate while you're doing this as well.
Don't take no for an answer. If you talk
Exactly.
to 3 people and all 3 of them tell you no, it's possible you might be getting to the right answer. The reason why those of us in the Find My Way Home Expert Network deal with this a lot is that Scott and I started writing about this 6 or 7 years ago. So there's a ton of traffic. We have a lot of Google juice. So when people get told a crazy answer by a loan officer and they start Googling it, our stuff pops up. I had a client just yesterday tell me he's actually a doctor, so we have additional options besides just our normal IBR stuff. Only wants to buy a $450,000 house. It's like easy slam dunk, and he's been working with the lender for 30 days, and they keep coming back and telling him they need more documentation to be able to determine what his full payment is going to be. And we could go on and on and on with stories of just people being told the craziest stuff. I have a house that I was planning on flipping last year. Market ended up good, rents went up, we ended up with a bunch of equity in it, so we kept it. I have a lovely couple comes in one day, and I start talking to them like, why are you guys looking at renting? You should buy. And they go through the situation with their student loan, and they go, oh, we have too much in student loans. You got to use the 1%, and we don't qualify. I go, who told you have to use our loan officer? Well, who's your loan officer? Oh, it's my brother. Like, okay, well, we got a family problem here because your brother's dumb. So in the nice way, I said, unfortunately, your brother's like a lot of loan officers. They're just not familiar with the guidelines. We went through it, just the same conversation that we're having here. And unfortunately, I didn't get to rent to this lovely couple because they were able to go buy a home. And I also didn't get to do their loan because I explained it to them well enough, 2 sharp people, that they went back to their genius brother and said, hey, dummy, here's how we do our loan. And they were able to buy a home instead of having to rent. And, that was late last year. So they got into a home, got some appreciation, and missed out on this giant spike in interest rates.
Along those lines, Josh, there are also some underwriters that just really refuse to read the guidelines, or they choose to interpret them. See, most underwriting guidelines are not black and white rules. They're kind of guidelines, and you have to read into them. And sometimes what it doesn't say is as important as what they do say. And Scott, you had a scenario. We had somebody called me off of Find My Way Home. She was in escrow. She loved her loan officer, and she kept explaining this scenario to her, why she couldn't use her student loan payments and how she wasn't going to be able to close on this house because of her student loan payments. And I just kept scratching my head, and I was like, that does not make any sense to me. You should be able to follow this guideline. And she went back to her loan officer, and she came back and she said, the underwriter said no. And I said, I need to introduce you to somebody that I know in Colorado, and tell us how that conversation went.
We got the call. I think you told us she was going to be calling in. She did call in. My wife and business partner and I were on a conference call with her, and same thing you just said. She absolutely loved her loan officer. She'd been working with her for months, but for whatever reason, I don't know if it was a company policy, if it was an underwriter, if they only sell their loans to Fannie, there was something that was keeping them from lowering her student loan payment to what the guidelines are. Once we explained to her that we've done this before, that's why we're in the Find My Way Home network. We got her loan application. She was buying the house that she was living in. We had her close within just a few weeks, and now she's a happy homeowner.
Yeah. Yeah.
The funny and amazing thing about this is, like, when you know the guidelines, these are really easy loans. You almost feel like stealing, like you took the candy from the baby, because you have this infant loan officer over here that has no idea what they're doing, and you go, okay, you don't know how to eat that candy. I do. So there's some guilt with it, just a little bit for a small second, but it really, I am amazed. Scott Shang, you and I, what was about 2017, 2018 when they kind of got the guidelines dialed in, where you and I said, well, that's the end of the gravy train. Most any semi-sentient loan officer should be able to do this. And yet here we are 4 or 5 years later, still getting multiple calls every month from people getting misinformation and being told no when they absolutely qualify. And the thing is, like, there's two things that can happen in bad in terms of getting wrong information when you talk to a loan officer. One is a false positive. You don't qualify and they tell you everything's great. You get into escrow, you make a deposit, you pay for an appraisal and inspection. We get to the end and we go, no world did you qualify. That's bad. A false negative over the last 2 years could have been equally bad. Let's say in late 2020, you want to buy a house, you get to the wrong loan officer, they say, oh, I'm sorry, you got student loans, you don't qualify. You would have missed out on about 30% of appreciation. And instead of having a 3% interest rate, you're looking at a 5.5% interest rate or a 5% interest rate today. So there are real costs to not getting good information. I tell people, I am never going to be mad at you for shopping. The worst examples of people getting taken advantage of, getting false positive or false negative answers from a loan officer, are the person that called and talked to only one person. It's also the same for getting really bad terms for your loan. So bad answers, bad terms, and the actual, Scott, I don't know if you remember the exact number. Isn't it 72 or 76% of borrowers will do a loan with the first person that they talk to? Hopefully
Yeah, it's even higher than that, but yes. Yeah.
Hopefully the first person you talk to is great. What I can say is our industry is a full-blown 80-20 industry. 80% of the people are average to awful, and you don't want that. You truly don't want that.
Well,
You would be shocked and amazed at the things that we see loan officers doing on a daily basis.
Well, and quite frankly, for that specific reason, that's why we started Find My Way Home, and that's why we got experts like Scott and you and a bunch of other people on here, because a consumer's options are limited to the experience of the person that picks up the phone. And if 75 or 80% of the people are only going to do business with the first person that picks up the phone, you assume when you call the doctor's office that they understand medicine. So there's really no reason for you to think otherwise. But when you find out that they don't know, that's when you have Find My Way Home. And the overwhelming majority of our tens of thousands of visitors a month have been told no or given misinformation or multiple answers from multiple lenders, and they go on Google and they're like, there's got to be an answer to this, right?
Well, Scott, one of the things that we talk about, one of the worst things that's happened to the mortgage industry over the last 15 to 20 years is the McDonaldization of mortgages. We have giant national lenders with massive call centers that they're loan experts, that they'll tell you are loan experts, just went through a 6-week training class coming out of a job at 24 Hour Fitness or GNC or delivering pizzas. And I'm not kidding. You can look this up in the NMLS and see their license number and their 10-year self-reported work history and see where they were working 6 months ago. And because the marketing is so pervasive and so good and slick, if you look at these ads, they're really good ads. If they were actually delivering the promises they make in the ads, it would be awesome and wonderful. But there's no such thing as push button and get mortgage. That's a topic for another show. But the reason is this is a highly government regulated industry. Could it be much better, easier? Definitely, the technology exists to make customized mortgage decisions for everyone, but housing is really sensitive. You have racial disparities, inequality, any number of things that we have to paint with broad strokes versus getting granular down to individualized decisions. So we have, and we're in the middle of it right now. You're seeing better.com melt down, and they will be gone within a year or two. If they survive this, I will be shocked. But a giant mortgage company, venture capital backed with really smart people, and I mean that honestly, really smart people go, that's a dumb industry. I'm smart. I'm going to fix it. And then they get in the industry and they go, well, maybe it's the government regulations making the industry dumb. So that the messaging that you see, that it's so easy to call the banner behind home plate on the baseball game, or the advertisement on the radio or on ESPN or on the billboard. This stuff is not rocket science. I am not a rocket scientist. I'm not a genius physicist or chemist, but
But you
it's
do
really,
have a fine mustache.
I do have a fine mustache for today. It may be gone tomorrow, but it was fun for today. But with that, our business is really complex. And if you don't have an eye for detail and an ability to view that complexity, and 20 something years, and it doesn't take 20 something years, but it takes 5+ years before you know all of the things to look for. And I'm sure there's an exception to every rule. You can show me someone that's been in the business for 18 months and is great. We have a friend of ours, Kyle, that's been in it for 3 or 4 years and is spectacular. But it just takes time and seeing files and having an eye for detail and a concern for getting the right answers. And in a call center, it is purely kill them all, let God sort them out. It's do the best marketing to generate as many leads as possible and filter out the easy ones and let your kids in the call center get those closed.
And this might, Mary had a follow-up question, which brings up another really good point, because there's not always one answer. So Scott, Mary was saying if you could repeat again how to lower the student loan debt by extending the term, but there are also some real negative aspects to refinancing your loan and recapitalizing that interest on that loan. I mean, that is an option. Absolutely. We also we work with a company who basically, she's a millennial who started this company literally because of all of these challenges. Because what she said is the overwhelming majority of student loan holders or student people that have student loans are just given one payment option, and they don't always know their options. So this company is called Loan Sense. I don't know, Josh, if we can put it up. If we can put it up there, it's MyLoanSense. Yeah, MyLoanSense.com. And what they specialize in is not refinancing your loan, but right-sizing your loan, and that's almost always putting it into identifying if you qualify for loan forgiveness, and then getting you into an appropriate income-based payment that you can afford until you qualify for the loan forgiveness. And they assist with all of the paperwork, and actually they specialize in helping people get into these loans, or get their loan done before the loan closes. So if you start the process, it takes them maybe a couple of weeks, and they negotiate with your servicer. They do all the paperwork for you. So there are different options. One option is refinancing, reamortizing. Another option is taking your existing loan and just putting it into a different payment structure, which is maybe going from amortized to into an income-based repayment. So yeah, there are a couple of different ways to do it. I would recommend you talk to somebody on the Find My Way Home network and figure out what those options look like. Because again, this stuff is complex. There's a lot of moving parts.
Well, Scott, as far as going, you can go back to the servicer and actually talk to the representative and say, I need to get the lowest payment possible. And
Yes.
how do I do that? And they'll tell you how to do it. The one thing is that's also not a permanent, you don't have to do that permanently. You can just do it until you get your mortgage and then go back to what you had. So it's all you're doing right now is lowering your payment to get into a house. And then once you get into that house, then you can go back and figure out how you actually want to pay that.
You just probably want to make sure that if your intention is to do it temporarily, that it's not stated anywhere on any documentation.
Right. No,
Underwriter will want to know that that's what your payment is.
No, I told someone to, go contact the servicer, tell me what the lowest payment possible. And they were worried that was going to lock them into that. I just wanted them to know that it was it's as permanent as you want it to be.
Right. You want to go back. And plus, if you have a minimum payment, you can pay double the payment. If you want to pay off your student loan payment, you can make any payment you want. We're really just talking about, for the purposes of qualifying for a mortgage, what does the underwriter and the lender need to see in order to, quite frankly, give you enough purchasing power to qualify for that home. Just like the story of Josh's renters that he lost, but he did the right thing. So I'm very proud of you.
You can't throw all the starfish back in the ocean, but for the ones that you do, you made all the difference in the world. And I'm sure when I was taking my little 2-minute vacation, when my internet went wonky here, you guys with this link on the screen for My Loan Sense, I would talk to or tell anyone who has student loans, talk to these guys. It's a complex situation. We just talked about why it's important to get with an expert loan officer. I don't know that there are a lot of experts in the student loan field. If you have a significant amount of student loan debt and you want to make sure you're getting credit for all of your payments for the forgiveness, if you're minimizing the payment as much as possible for qualifying for a mortgage, if you're making sure you're not doing something that costs you more in the long run, you want to talk to experts. So it's
the dangerous thing, Josh, is that Loan Sense is more of is more of sort of a consulting kind of a counseling company. They're going to counsel you. There is a small cost if you want them to do all the paperwork for you, but you think it's bad trying to go out and get call center lenders. The same plague affects student loan refinancing companies, because those companies make a lot of money by refinancing your loan, and they're not doing you any favors. But in most cases, they're charging you a lot of money. They're costing you a lot more money in the long run. So it can get pretty pretentious out there. It can get pretty scary. So, Josh, we kind of talked about all of the, we talked a lot about how to qualify, how to use each program. What are kind of some other things we need to consider out there? Like what if you missed a payment, or what if you went into default on a student loan? What are some of the scenarios that you've run across that, get it even a little bit more hairy?
Scott Beatty, I don't know how often this comes up for you. I do see a lot of clients who've had significant issues with their student loans in the past. Usually by the time they're looking to buy a home, they've got them figured out and got them brought current. A lot of times I will see 8 student loans that were late for 4 years in a row because they graduated, didn't realize that the payments had started, addresses or bills are going to mom's house, whatever. And they wake up and they go, oh my God, what happened? And they get back with the servicer, they consolidate them, bring them current. And so the credit score is decent and we're able to do the loan. But Scott, do you see much of people actually with current issues and late payments and problems with their student loans?
Not so much. Well, kind of to your point, people will see that they were paying, they didn't pay for 3, 4, 5 years. A lot of people think that's an anchor around them right now. And it's not. Like you said, they got caught up. They're in the good graces of the student loan company. they're fine. They can most likely buy a home. If you the one good thing about forbearance, those people that were late for 4 years, all of a sudden they got current. All their credit scores got good. So a lot of those folks didn't make a house payment for student loan payment for 4 years. They haven't made one for the last 2 years, but their credit's good. Student loan payments are showing at least on time. So some of those folks are getting into homes that otherwise wouldn't. But if you have a one-off here or there, you forgot to make a payment, that's not going to kill you either. So long as you're mostly good and your credit score is good, you should be able to qualify. The one thing would be is if you did default on a federal student loan, that could affect your ability to get an FHA loan. We just had someone call us about 2 weeks ago. Their deal was falling out at another lender, and it turns out they had a defaulted student loan a little over, right around 3 years ago. So they were calling in a panic trying to figure out, and actually that call came in through the Find My Way Home network, like you said, Googling for answers because stuff didn't sound right. And no one had mentioned the system that lenders use. It's called CAVERS. In this CAVERS system, if you've defaulted on a student loan, it is to prevent the government from lending you money from other sources that may not know about it. So all federal lending agencies use this system to make sure you haven't defaulted on a federal debt. In this case, they had, and they didn't qualify for conventional. So they, last I know, they stuck with their loan officer, but they were able to go back to that loan officer with a lot of questions and a lot of ammunition that I gave them to go back with that. So if you defaulted, and it doesn't, you could have also defaulted and it won't even show up on that report, but it does mean that you do need to talk to a loan officer that understands the ins and outs of that.
And I don't mean to sound bitter, Scott, but I will say, all three of us, how many times have you given someone a roadmap to go back to their loan officer? And I get it. From the consumer's perspective, you don't want to start over. In a current market like now where rates have gone up, starting over can cost you a chunk of money. So I am happy to get the consumer the right outcome,
Right.
But it's not fun to reward a loan officer that doesn't know what they're doing with their consumer, getting online, doing the research, having the conversation with one of us and getting the details and going back going, hey, here's the roadmap to do your job, buddy.
Right.
The one thing I wanted to maybe add to this is if you defaulted in the past and then you negotiated a repayment plan later afterwards, and sometimes that CAVERS alert is still on there. So you want to make sure if you are in a repayment plan, but you still have like this default, especially now the last 2 years, I don't really know how you would deal with that. But if you defaulted, but now you're making payments, same sort of thing with like tax liens, right? So, okay, as long as you can show you're in a repayment plan and you've been making payments on time, it's possible to get, take that to CAVERS and say, no, I'm making the payments and they're on time, and they could potentially remove that alert and allow you to move forward. You just have to show that you're back on track.
Right. Just because you show up in that report doesn't mean you're done. There's more work to that you still have to do.
We had one last week that showed up that it was actually identity theft. Someone had taken a student loan out for a veteran, and they were trying to come do their VA loan, and they had to go back to CAVERS. So it's going to take a little bit of proving to CAVERS that he didn't actually go to college somewhere in the mix and take out this student loan that he never paid. But it was an interesting one.
He didn't go to Berkeley while he was deployed overseas?
He did not.
Okay. That's good news. But that's to your point again, Josh, and no, you don't sound bitter, because we are biased. We are on the receiving end of hundreds, if not thousands, of consumers that have been given wrong information. And it's not just that they're misinformed. They could just be new. They could also just be lazy. Right? They just don't want to put the work in and do the hard work to try to figure it out. There's a lot of folks out there that are just like, is this easy? Is it easy? It's hard. I'm not going to do it. Is it easy? Is it easy? And if there's any sort of thinking that's involved, It's important to know, and the reason why we do this is to build awareness, to let people know that there are people like Scott and Josh that are professional loan officers with years and years of experience that are more than happy to answer your questions and walk you through and kind of guide you through some of these decisions. We're not we kind of have this affliction where we don't like to hear no. We're like, I'm going to beat that thing to death. I'm going to track this thing down to the ends of the earth until there is no more guidelines for me to review.
Exactly.
And the fun thing is the guidelines are always changing. So
Yes.
you can think you know them. And the funny thing from that perspective, I'll tell anyone that will listen, and even those that won't, I trap them and make them listen. In the 90s, we had a giant bookshelf with giant 4-inch 3-ring binders. That was where you had to go. There were no such thing as PDFs and Google and all that fun stuff. So you would sit there in the office and go through the binders. Now we Google it. You go to the lender's websites. You go to the agency's websites. You can search it. You can hit Control F in the PDF, and next thing you know, there's the guideline you're looking for.
But that's one of the things that you guys have done really good with Find My Way Home is like you said, Scott, the guidelines are still not written really clear. So you guys have done the legwork. You've gone out there and you've actually gotten answers from the agencies if they're not clear, and you've made it in an easy to digest, readable format that a layman can understand. And that's why I think you have so much traffic to the site. You're taking something that's very difficult, and it's still difficult. You're just making it so people can understand it. And I think that's the real value.
Yeah.
So I think we've
about covered this topic, Josh.
That's exactly what I think we've covered the topic. We'll be back next week with more experts and more conversation about topics that are impacting people in the market to buy and finance homes. If you have questions, if you're watching this on the replay, if you see it on YouTube, if you see it on one of our Facebook pages, throw a question in the comments. If you'd like to see a topic covered, we're always open and looking to go through things. We primarily go through what gets the most traffic on the website, the most problems that we're seeing, but we're absolutely open to any questions that you may have. So Scott, thanks for making everything confusing for all of us tonight by sharing a name. But we appreciate you being here, appreciate you sharing your expertise, and until next time, we'll see you guys.
Thank you so much.